Capital importation into the country dropped significantly, falling by 1.68 trillion naira, equivalent of $4.08 billion in 1 year, as foreign investors seems to have quit the Nigerian market. According to the latest capital importation report from the National Bureau of Statistics, during the same period in 2021, foreign capital inflows into the country fell by $4.08 billion to $4.47 billion. Now, a breakdown of the 2020 figures shows that in the first quarter of 2020, capital importation into Nigeria stood at $5.85 billion, representing an increase of 53.97% compared to Q4 of 2019. During this period, foreign portfolio investments contributed the largest amount to capital inflows, accounting for $4.31 billion of total capital importation. Despite the drop, analysts are of the view that there is hope that the efforts of the Central Bank of Nigeria to meet FX demands and clear areas would incentivize portfolio investors to return to the Nigerian market. Well, let's turn to our guest so that we'll analyze this. I have joining me via Skype an investment analyst at United Capital Limited. That's Mr. Ayorinde Akinloye. Mr. Ayo, it's good to see you. How are you today?
Thank you very much, Tolu. It's a pleasure to be on the show. Thank you for having me again today.
Yes, the figures are down by 1.68 trillion naira. That's an equivalent of $4.08 billion in 1 year. How do you react to this in the first place?
Yeah, clearly it was expected in terms of capital importation flows into the country. When you look at the numbers, yes, you pick Q3 in isolation, which is if you pick Q3 in isolation, you would notice that it was higher than what we had in Q3 last year. But we have to remember the fact that we had the COVID outbreak and the impact of the pandemic and the lockdown on investor sentiments around that time in 2020. So that sort of provided a low base when comparing to Q3 2021. But when you look at 2021 as a whole, based on the data that we have available right now from the National Bureau of Statistics, we have for the first 9 months of the year, we can see a significant drop-off from what we had last year. But you also have to note that the first quarter of last year was a period in which there was no COVID outbreak, and FX was, very much still available within the economy, and foreign investors were able to move their funds in and out at least at a decent waiting time, basically, in terms of getting FX. But immediately COVID struck, the CBN had to manage its FX resources because of the decline in oil prices, production, and things like that. And as a result, the CBN basically reduced its intervention in the FX market, and foreign investors were basically trapped. And what we had in 2021 was a case where FX liquidity improved marginally, but it wasn't enough to fulfill some of the all the backlogs that we had. And as a result, foreign investors in particular are looking at the fact that if this cycle continues, then why should they continue to expose themselves to such high FX risk? So we look at all these factors overall in terms of FX liquidity. Also, when you look at the interest rate on our fixed income instruments, because we know that most of the capital flows that we get come from foreign portfolio investments, particularly in our money market instruments, and then in some cases our bond instruments. But you look at the interest rates on most of our money market instruments, they were all below inflation rates, and it means we had negative returns basically. So when you factor negative returns on your investments with the probability of with a lower probability of being able to repatriate your capital out of the country when you want to, then you're able to clearly understand that for foreign investors, it wasn't a good incentive for them at all for them to bring in money into the Nigerian economy last year, and as a result, we had that significant decline that we saw in foreign portfolio investments and in capital importation overall. Foreign direct investments also remained underwhelming because most of these legacy economic issues that we have, when you're talking about infrastructure, when you're talking about economic systems and institutions that govern the economy and the legal space as a whole, these things are not yet. These things have not been put in place, and as a result, foreign direct investments continue to dwindle last year. So all in, it just points to the fact that the economy remains broadly unattractive for foreign investments, and we would continue to struggle until we put the right structures in place.
Repatriation of funds remains an issue, a big one for that matter. But I want to ask, we still seems like FPIs seems to be on the high side other than FDIs. What's the cause of this? Confidence or other economic issues?
Well, yes, so definitely, like I mentioned earlier, the key concern for investors basically looking at the Nigerian market. So when we take away the FX side of things now, looking at the economic situation of the country, for example, first what you have is most of the infrastructural issues that we have within the Nigerian economy. They've been there for years and they have not been resolved. You know, we have infrastructure problems in the power sector, we have infrastructure problems in our maritime sector, we have infrastructure problems in our transportation sector. That is on infrastructure side, right? When you now come to institutions, basically the institutions that govern the economic, the business, and the legal environment, these institutions are not empowered enough for them to implement the law and to the letter, and basically some key individuals still have the ability to circumvent the legal system, particularly when it comes to enforcing business contracts, economic agreements, and things like that. All these key things have not been resolved. That is on one side. You come to the Nigerian consumer market on its own. The concern is Nigerian consumers on average have become poorer as years has gone by. From 2010 down to 2015 to 2020 till date, the average Nigerian consumer has just continued to become poorer and poorer as the year goes by. So even the markets, though big, the size of the market is no longer the most important thing right now. It's what's the purchasing power of that market. And we can clearly say that the purchasing power of the Nigerian market has continued to dwindle, which is another key concern for investors. Now, when you put all these factors that I've highlighted together, from inadequate infrastructure down to not having strong enough institutions to enforce business contracts, enforce economic agreements at all, and then you also add to the fact that the market, though big, is very poor. When you put all these factors together, definitely as an investor, I would not be willing to bring in foreign direct investments into that kind of country, into that kind of economy, because foreign direct investment means I'm coming in, I'm installing machinery, I'm investing long-term capital in that economy with the hope that, yes, consumers will continue to get richer and they will be able to afford services or goods, whichever space I will be playing in as a foreign investor. So when I look at all those factors, it becomes undesirable for me, because there are other alternatives I can look at within the emerging market and frontier market space. So rather than invest in Nigeria, I would rather consider Ghana, I would rather consider Egypt, I would rather consider other more attractive African economies that are getting things right, both on the infrastructure side, on the institution side, and even down to the quality of the market. It's not necessarily the quantity of that market. So those are key factors why foreign direct investment has always remained low for the Nigerian economy. And on the other hand, as an investor, when I know that I can't bring in that long-term capital, what option do I have if I want to still play in that space? Then the option I would have is to play on the short term, buy short-term bills. So our treasury bills, our OMO bills, and other money market instruments like that are opportunities that foreign investors take advantage of, which is why foreign portfolio investments are always the largest portion of our total capital importation into Nigeria. And until we get things right on those factors I've highlighted earlier, these investors will continue to prefer short-term instruments in our markets, basically bring in their money, and after 1 year they take it out again. So until we resolve those long-standing legacy issues in our economy, we would continue to attract just hot money, and we would not attract permanent capital from the international market.
Just like you said, Ghana is becoming the preferred destination just beside us here, and we see what's happening. But I'm also thinking about reforms with regards to our international trade policies, and of course, repositioning with prospects. We know the AfCFTA is also around the corner. What more can we do to improve trade internationally?
Okay, yes. So the AfCFTA definitely is one major game changer that we're still looking forward to being implemented. From all indications, the AfCFTA should have started being implemented since last year, but it doesn't look like we have started seeing that implementation for now. But clearly, we think that the AFTA agreement is one thing that would definitely make trade much easier and frictionless between African economies. But the problem for Nigeria is we don't have so much to offer these other African economies. One of the key things that we always look at as a barometer for the Nigerian economy is productivity in terms of USD productivity, right? What do we have to offer other economies? If we have something to offer other economies, we get more foreign inflows, more USD inflows because we are able to sell more via exports. So the AFCTA coming on board does not necessarily improve the situation of things for us. Yes, trade, it helps trade within the African region, but most likely other economies are able to attract foreign capital would benefit more from AFTA than we do. Why? Because we have the market. In Nigeria, we have a big market, although, like I mentioned, the quality of the market is another strong debate, but we have the market, and most of these investors most of these foreign investors who want to target our market would not necessarily need to come to situate their factories or their companies here in Nigeria anymore. They would be able to situate their factories and all in maybe a neighboring Ghana or in any other economy or country where they have that incentive, where they have that assurance that they can invest in, and the security for their funds, and they're able to trust the economic process and system in that particular country. And from there, because the AFTA would remove all the trade barriers and things like that, it becomes easy for them to export those commodities from those neighboring African countries into Nigeria. So unless we position ourselves properly, that means we need to look internally now, not even the external side of things. We need to look internally, position ourselves in such a way that we are going to be able to attract these foreign investors into the Nigerian economy to establish their factories here, to establish their companies here, to establish those manufacturing plants and those service-based organizations here. And from there, we can now begin to take advantage of AFTA, because it means we are now going to be able to export to other African countries basically zero tariff. But if we don't get things right internally, if we don't get our infrastructure right, if we don't get institutions right, if we don't get our business operating environment into such a condition where investors are attracted to bring capital, we would become a victim of the AFTA agreement, because it basically means we become a market, a target market for investors, but we will not be getting the capital. We will basically be spending on goods that are being imported into our country. So it's important in terms of reforms. We need to look at, even beyond the infrastructure side of things, we need to look at our economic reforms. We need to look at the foreign exchange market. How do we make the foreign exchange market stable enough for foreign investors to have confidence in our exchange rates, eliminating the multiple exchange rates regime and things that we have now? How do we resolve those kind of issues? How do we resolve issues such as our institutions that govern our businesses? How do we ensure that the legal system is empowered to be able to enforce contracts, and foreign investors have that confidence that when they go into binding contracts, they have a legal system to rely on to enforce those kind of contracts? When we reform those, more simpler things, then we can begin to, talk about how we can solve our infrastructure problem. But until we resolve some of these little issues here and there, which, as little as they may be, they would have significant impact in terms of how our economy is perceived in the international community. Until we resolve some of these issues, then AFTA may not necessarily even be of significant benefits to us, because we just continue to export oil, and oil is not, we don't have a market for our oil in the African region. The market for our oil is in the international markets outside of Africa. So we need to increase our productivity. We need to have other things that we have to offer the African economy in order for us to benefit for AFTA. Or else, like I said, we would just become a victim of the AFTA agreement.
Sometimes I wonder, and I ask that question, if Africa is really ready to take advantage of it. Not just Nigeria, but Africa. But some countries actually are doing pretty well, particularly when it has to do with infrastructure and all of that. I'm wondering why it is so difficult to replicate working models like that for us in Nigeria to make us able to meet up this market. Now, with all of the challenges all around, globally, domestically, what are your projections for the entire global space? Actually, we talk about trading in 2022.
Okay, well, When we take it from a global perspective, definitely we expect that trading activities in terms of import and exports, trade relationships between countries will continue to improve. Yes, COVID-19 is still out there and remains a significant risk, in a situation whereby we have a much deadlier variant of the virus, but right now we think the probabilities of going into another lockdown is extremely limited, even on a global scale. We think based on the lessons learned from 2020, most economies have recognized the fact that they can't afford that kind of a lockdown anymore. So rather than lock down the entire economy, basically we are basically going to rely on coping mechanisms, our coping measures, basically to live with COVID-19. So when you take that out of the equation, we look at the fact that most countries would now be able to, in terms of movement of goods and services from countries, between countries, it would be easier and it would be smoother. That's on one end. On the second part, we also look at the fact that growth projections are very, very strong. The IMF is very bullish on, that's International Monetary Fund, they're very bullish on global economic growth. Same with the World Bank and same with our projections from our own in-house research team also. So we're very bullish on global economic growth, although yes, we believe that the wealthier nations of the world would likely even outgrow some of the poorer nations, basically because of the strength of their wealth, and then also because they're able to cope with the COVID pandemic much better, and they're able to achieve better vaccination rates. Basically, that's on the COVID side. So we think that growth is going to be very strong, and that definitely directly correlates with trade, because for a good example would be the oil markets, where the expectation of strong oil demand and a bit of tight supply would continue to keep oil prices high. That's just an example of the fact that investors are confident that oil demand is going to be strong. So that's just one example of several other commodities that we trade internationally. Also, in terms of agricultural produce, mineral resources and all, we expect demand on that space to be strong as long as COVID remains under control. So those are basically the things we expect to play out in 2022 for the global economy. But when you trickle it down to the domestic economy here for Nigeria, we still believe a lot is dependent on our ability to resuscitate our oil production. So yes, our exports may increase, but we need to critically look our imports may increase, but we need to critically look at our exports, because, for example, the OPEC monthly oil market reports that came out just about yesterday, our crude oil production declined again in December, just when we thought we're out of the woods in November when oil production improved, but it declined further in December. So we need to sort out some of these issues that we're having at our oil terminals in order to be able to drive exports in 2022 and also improve our trade volumes, our trade value this year. So that's going to be critical on the domestic side of things.
Brilliant submission there. Yorinde Akiloye is an investment analyst at United Capital Limited. Thank you so much for your time, and do enjoy the rest of your day.
Thank you for having me, Todo. You too. Thank you.
All right.